Welcome back. If you've spent any time at all in the financial markets, you already know the noise is just deafening, right? Between the endless strategy breakdowns and that constant barrage of trade alerts, it is incredibly easy to get completely overwhelmed by the sheer volume of information out there. So today, our goal in this explainer is crystal clear. We're cutting straight through all that noise. We're going to find the trading style that actually fits your life, your schedule, and your unique personality. We're going to compare day trading and swing trading, and hey, we're not doing this to tell you which one is objectively better, but really to help you discover which one is better for you. Okay, let's dive into this.
There's an absolutely crucial truth we really need to start with today. The best trading style is not the one that makes the most money. The best trading style is the one you can consistently execute. That right there, that's our foundation for today. We are completely abandoning the flashy influencer hype. You know exactly the kind I'm talking about, right? The screenshots of massive overnight gains, the luxury cars, the relentless promises of instant wealth. No, instead, we are pivoting to realistic consistency. Because let's face it, a highly profitable strategy on paper means absolutely nothing if it doesn't actually align with your real, everyday life.
We've all seen the social media myth. Fast wealth, luxury cars, the illusion of zero losses. It looks great, doesn't it? But the trading reality is entirely different. The cold, hard truth is that trading is a skill-building profession. It's exactly like engineering or medicine. It takes time, repetition, and a whole lot of grit. In reality, losses aren't avoided. They are managed, and emotional discipline is your absolute biggest asset, not a rented sports car. Once we accept this reality, well, then we can start making intelligent, strategic choices about how we actually want to participate in the market.
So first up, let's talk about day trading. Think of this as the sprinter's path. You're opening and closing trades within the exact same day. Literally zero overnight positions. You might hold a trade for 5 minutes, maybe an hour, but you always close it out before you go to sleep. And the absolute biggest draw here is control. Because you cash out daily, you completely avoid the risk of unexpected overnight market events. You don't have to stress about surprise economic reports or global news that could violently gap the market against you while you're fast asleep. On the flip side of that, we have swing trading. Now this is the marathoner's path. Instead of minutes or hours, you hold positions for several days, weeks, or occasionally even months. Rather than obsessing over tiny intraday fluctuations and constantly reacting to every single tick of the chart, swing traders are stepping back. They're looking at the bigger picture. They want to capture larger, medium-term market moves, so they analyze the broader trend, enter a position, and then, this is key, they give the market the time and the breathing room it inevitably needs to reach its target.
And this brilliantly illustrates the real-world difference between the two. Just look at the time commitment. Day trading demands anywhere from 4 to 10 hours a day of being completely glued to the charts, reacting in real time. Swing trading, however, it asks for just 30 to 60 minutes a day. That is an eye-opening realization even for folks who have been around the markets for a while. Time is a finite resource, and trading competes directly with your job, your family, your studies, and frankly, your rest. Choosing a style isn't just about strategy, it's about deeply honest time management.
Let's break that time down into a tangible daily routine. The day trader's environment is incredibly high focus. It requires constant monitoring for 3 to 8 market hours straight. You're scanning charts, executing entries, and managing risk on the fly. It is intense. Contrast that with the swing trader's routine, which is really structured entirely around real life. You do a brief 10 to 15-minute morning review to check conditions, and then maybe a 20 to 45-minute evening review to analyze charts and plan adjustments when the day is totally done. It shows us exactly why day trading demands your absolute, undivided attention, while swing trading offers incredible flexibility.
To make this a bit more relatable, consider Chinedu. He's a busy auto parts entrepreneur based in Lagos. He's managing customers all day long, so he has very limited screen time. For him, swing trading is the absolute perfect fit because he can confidently do his market analysis at night. On the other hand, we have Fatima, a university student in Accra who's currently on holiday. She has highly flexible hours and naturally loves fast-paced analysis, so for her, day trading fits beautifully. Neither Chinedu nor Fatima is wrong in their approach. Their circumstances are simply different, and they've chosen the correct tool for the job. Now let's shift gears for a second from time to capital. Whenever someone starts out, they always ask, hey, how much money do I need to start? But honestly, that is the wrong question. The real question, the one seasoned professionals actually ask is, how much money can I afford to risk? Your trading capital should be entirely separate from your rent, your food, or your daily obligations. If you trade with money you desperately need for survival, the emotional pressure will absolutely crush your decision-making. You must only trade with capital that, if lost, wouldn't disrupt your financial stability at all.
So the crucial point is the 1 to 2% rule. This right here is the golden rule of risk management. It's literally what separates the professionals from the gamblers. You should never ever risk more than 1% to 2% of your total account balance on a single trade. If you have a 1 million naira account, your maximum risk on any given trade should be 10 to 20,000 naira. By keeping your risk this strictly controlled, you can endure a string of inevitable losing trades and still keep your account entirely intact. Remember, survival always comes before profit. Always.
And how exactly do you enforce that 1 to 2% rule? The stop loss. You probably already know what it is, but I want you to think of it strictly as a safety belt. You hope you never need it, but you would be crazy to drive without it, right? Professional traders use stop losses mechanically to survive the inevitable bumps and sharp turns in the market. Amateurs, though, they hold on to losing trades, they disable their stops, and they rely on hope that the market will magically bounce back. And let me tell you, hope is definitely not a trading strategy.
Which brings us to a really profound truth. The biggest battle in trading actually takes place in the mind. You could have the most sophisticated, proven, data-backed strategy in the entire world, and you will still lose money if you lack emotional control. Every single trade creates emotional pressure because real, hard-earned capital is on the line. The market is basically a giant mirror. It will reflect every single one of your psychological strengths and weaknesses right back at you with zero mercy.
And man, when that pressure hits, the traps are waiting. Revenge trading, where you furiously try to win back a loss. The inevitable FOMO, jumping into a massive price spike super late just because everyone else is cheering online. The dangerous overconfidence after a 3-trade winning streak where you suddenly act invincible and totally ignore your risk rules. And of course, holding on to losers based purely on hope. These traps move incredibly fast. They creep up in seconds of anxiety, and they're responsible for destroying far more traded accounts than bad technical analysis ever could.
Now, what's really interesting about this slide is how it turns the mirror back on you. Let's do a quick personality match, shall we? Are you action-oriented? Do you thrive on making fast decisions, handling intense pressure, and needing immediate feedback? If yes, day trading might just be your lane. But are you more analytical and patient? Do you prefer careful planning, deep research, and feel completely comfortable waiting days for a thesis to play out? If that sounds a bit more like you, swing trading is your answer. Know yourself first and then pick the strategy. So let's make this actionable. Before you risk a single dollar in the markets, you need a strict trading plan. It's like a blueprint. Step 1, choose your style based on your actual life and your personality. Step 2, set your risk limits. Lock in that 1 to 2% rule we talked about. Step 3, define your schedule. Literally block out the exact hours you will trade or analyze. And finally, Step 4, establish unbreakable rules for exactly when you enter and exit a position. Having this exact plan written down is your ultimate defense against all those emotional traps we just fired through. We end our explainer today with a simple yet provocative question. Which trader will you be? Will you chase the exhausting social media fantasy of fast wealth, or will you actively choose the disciplined, structured path that actually fits your reality? Look, the financial markets offer incredible opportunities, absolutely. But they demand absolute respect, deep self-awareness, and a rock-solid plan. Think about your time, your personality, and your capital. Make your choice, build your plan, and stay consistently focused. Thanks so much for joining me on this explainer, and I'll see you next time.